Man, I hope this video gets a lot of views and shares because I think it might be one of the more important videos I've made in a while regarding inflation and our expectations of what gold and silver should be doing in the future. And it comes down to the saying that I recently thought up, which was we have the princes and then we have the paupers as far as inflation is concerned, and who controls prices and who controls inflation. On one side, we have the princes, which is the government. And then on the other side, we have the paupers, which, that's me, you, and everyone else in society that turns over the dollar. Now, both impact inflation in different ways. But in my view, what we should be expecting in the future is more inflation coming in from the paupers. We had inflation dramatically coming in monetarily from the princes, the government, Federal Reserve and the Treasury issuing bonds to dramatic levels. And we saw gold and silver react pretty strongly last year in response to that. But that reaction has happened. Next, what we should be expecting is inflation coming in from the paupers, me, you, and the rest of the economy that turns over dollars. This is one of the reasons why people talk a lot about this is the 10-2 yield curve, and why I talk about it a lot. Because what you're seeing here and where we are right now, which is in that yellow shaded area, is that we are approaching our midway point in this 10-2. Generally, it's somewhat of a cycle here. We're in the midway point. We haven't even reached the top. And usually when we reach the top, we usually, start to come down a bit more. And after the last recession, when we hit that top, we then start to get, asset purchases reduce. We start to see the Federal Reserve increase their federal funds rate from where it was. And that helped to bring down that 10-2 yield curve. But when that yield curve steepens to the upside, what that generally means for many people and many investors is that we should expect inflation. Now, that's inflation coming in from you, me, and those of us who are within the economy turning over dollars. Now, what I'm talking about is essentially the quantity theory of money. And this is it right here. And the M represents the money supply, and the V represents the velocity of currency in the economy. And P times T, I like to call it, that's nominal GDP. And how I view this with my new way of looking at princes and paupers is that now the money supply, I look at that as coming from the princes, and the V, I look at that coming from the paupers, me, you, and the rest of society. Now, M, remember that we're going to take a look at what M represents from the Federal Reserve, and that is this hockey stick here, which is essentially we're seeing the money supply increase. This is M2 right here, to dramatic levels post 2020 at a very strong rate. And it has been increasing just generally over the last, several decades. But recently in 2020, it increased at a pretty dramatic rate, right? Now, the velocity of currency, which again is represented by that V here, which is us, the paupers. The velocity of currency, on the other hand, since the late 90s, has been on a decline. So the velocity of currency, the amount of times you see dollars being circulating within the economy, has actually been on a decline for over 20 years now. And since 2020, it had a steep, very, very steep decline. Now, that's important to know because what that basically tells you as far as the health of you, me, and the rest of society within the United States is that we're not engaging in commerce in the way that we used to. And that could be for a variety of reasons. Could be because prices may be too high, could be more debt burdened. It could be a lot of reasons why we might not be engaging as much as we used to, but that's another video for another day. What I want to point your attention to is that post every recessionary slump that we've had recently, there's always some kind of uptick in the velocity of currency. Now, this is in the 90s, so obviously things were a little bit more aggressive back then. But during the slump, this last 20-year slump, we had a recession here after the dot-com bubble, and then we had a little bit of mean reversion to the upside. And then after the 2008 financial crisis, we had a little bit of a bump to the upside, though it wasn't that aggressive. And then it's been coming down for pretty much most of the last decade. And then obviously we had a very steep drop. And my view is that because we had supply and demand artificially choked out because of, lockdowns, I expect this velocity of currency to actually bounce back a little bit more aggressively than how things bounced back in or post the financial crisis of 2008. I expect this to bounce up a little bit more. Now, what does that have to do with inflation and gold and silver price expectations? Well, I want to basically show you that it doesn't take much for velocity to really impact nominal GDP and inflation. So here we have M2 and we have velocity, and we have different periods of time in which I took a look at, the relationship. So here we have Q3 of 1997, which was towards the top of nominal, or towards the top, I should say, of velocity of currency. And then we have Q3 of 2006, which was somewhat of a low. And between the two, for velocity of currency, there was that dip, as we start to see, but M2 kept increasing. So again, the princes kept printing money, and the paupers weren't spending as much as they used to. But even though we weren't spending as much as we used to because the princes kept printing money, our nominal GDP, let me move this over here, still increased. So what does that tell you? It tells you that without the support of the government printing money, our nominal GDP may actually decline. Just imagine if this remained the same, 3,965.1, and this decreased, this number, I should say, would be less than this number. Simple math. Let's just do a quick calculation here. I'm going to take this, copy it, and put it here. Again, if the paupers or the princes never printed money, we would have a lesser GDP than where we had in 97. So in order to keep GDP up, the princes have to keep printing money because the paupers aren't spending money in the way that they used to. Again, could be because prices may be too high. It could be because, obviously the depreciation of the dollar, could be because of debt, could be because of a lot of things. But because nominal GDP increased because of M2, take a look at how much it increased by. 59% increase in 9 years. And that was when velocity of currency dropped by 19 basis points. So imagine if, actually, let's take a look at the next one below. Here we have February 2010 nominal GDP and July 2013 nominal GDP. M2 in February 2010 was 15,432. Velocity was 1.4. July 2013, it went up pretty aggressively again. Velocity of currency dropped, but not too much. And still, it was an increase of about 17% in 70% in nominal GDP in 5 months. And I'm sorry, I should say that this is 5 months in between. This is either 2010 or or this was either 2013. I messed these years up, but this is a 5-month difference here. And if we take a look at the bottom one, now this is an experiment that I did here. This is July 2013 nominal GDP using Q3 1997's velocity of currency. So let's take a look here. So if we took this nominal GDP of July 2013, and then we took the velocity of currency from 97. So remember, velocity was at its highest in the late 90s. This is where we would be in nominal GDP versus where we were in actuality in nominal GDP. So that's how sensitive velocity of currency is when it comes to affecting the nominal GDP and affecting inflation. So let's do a little experiment here. What if we actually take this velocity of currency from 1997 and apply it to the velocity of currency in Q3 of 2006? So I'm going to copy and I'm going to paste. Take a look at where we are with nominal GDP here. All right, let's see what happens. It goes up pretty dramatically, right? Goes up to 15,000 instead of just 13,000. And that's only an increase of 19 basis points for velocity of currency. So my theory is that once we start to see velocity of currency rise up a little bit more aggressively, the inflation coming in from the paupers, again, that's you, me, and the rest of society, will start to grow, and we'll start to see gold and silver prices rise aggressively along with that. And we should start to see the 10-2 yield curve match in parallel with the rise of that inflation. So, here we have an article from Jerome or regarding what we saw over the testimony from Jerome Powell. Powell says the Fed is still a ways off from altering policy, expects inflation to moderate. Now, whenever I see something like that, I'm always thinking, well, what or when is this time horizon? Just take a look here of what he had to say. On inflation, Powell said it has increased notably and will likely remain elevated in coming months before moderating. Well, what is moderating and how many months are within the coming months? And above that paragraph, you have Powell noting that the Fed's benchmark of substantial further progress toward full employment and stable prices remains a ways off. So what should we expect when we see full employment from the paupers adding to inflation? We should expect more circulation of cash in the country. Though again, we're not going to be going way back up to where we were in the late 90s. We should just see like a little bit of mean reversion. The overall trend is still going down, still deflationary. But we should see a little bit of mean reversion there. And with that, we should expect gold and silver prices to respond as the CPI increases. So that's my theory. Please watch it again if it doesn't make sense right now. Let me know what you think in the comment section below.